Welcome to Clever Money Hacks, the channel where money moves and life improves. In today's episode, we'll be discussing the Great Acceleration.
The Great Acceleration. It sounds a bit like a movie trailer, doesn't it?
It really does. But we're actually digging into a very dense, very bold piece of economic research here.
We are. We're breaking down the Big Ideas 2026 recap from ARK Invest.
And we should probably put a little caveat right at the top. When you mention ARK, people tend to have a strong reaction.
That's a diplomatic way of putting it.
Right. Half the investing world treats their research like gospel. The other half thinks they're just, permanently optimistic.
It's a fair point. They definitely lean into what you might call constructive optimism. The assumption is if a technology can scale, it will.
Exactly. But our mission for this deep dive isn't to tell you what to buy or sell. It's to really unpack the logic behind their arguments. Because look, even if they're only half right, the world they're describing is going to look completely different in 5 years.
Well, their core thesis is that we're not in a bubble. We're at the very beginning of a massive economic shift.
And it's driven by 5 converging platforms, as they call them.
Right. And convergence is really the key word for today. We're not talking about 5 separate trends. It's about how they collide and amplify each other.
So just to get them on the table for everyone.
You've got AI, robotics, energy storage, multi-omic sequencing, and we'll definitely explain that one later, and blockchain technology.
The Avengers of tech buzzwords, basically. But let's start with the big picture, the macro view, because this was the first number that just made me stop and reread the page.
I think I know which one you're talking about.
We're all used to hearing about maybe 2% growth, 3% if we get really lucky. But this source is forecasting that real GDP growth could accelerate to over 7% by 2030.
It is a staggering number. And to put 7% in perspective, you really have to look back at the whole history of human economic output.
Okay, lay it out for us.
For about 400 years, up until 1900, global GDP growth was basically a rounding error. It averaged something like 0.6% a year.
So your life in 1600 wasn't all that different from your great-great-great-grandkids' life in 1800.
Precisely. No real change in standard of living. Then, bam. The Industrial Revolution.
Railroads, electricity, the telephone.
The internal combustion engine. That was what they call a step function change. It bumped global growth up to about 3%, and it stayed there for the last 125 years.
A 5-fold jump, and that's what we now think of as normal.
Correct. And ARK's whole argument is that because these 5 new platforms are all hitting at the same time, we're about to see another step function change, a 2.5-fold jump from where we are now, pushing us to that 7% figure.
And they think that's conservative. That feels incredibly aggressive.
They do. They actually suggest it could be higher if everything really clicks into place.
Okay, but here's my hang-up, and I bet a lot of our listeners are thinking this too. To get that kind of growth, you have to build things. You need massive infrastructure investment.
Right. Capital spending.
And we're seeing companies spend absolute fortunes on AI chips and data centers. It just feels, eerily like the dot-com bubble in the 90s. Are we just building digital bridges to nowhere again?
That is the multi-trillion-dollar question. And you know what? The source actually leans right into that comparison.
Oh, they do. Okay.
Yeah. They admit capital spending in tech and telecom relative to GDP is high, very similar to the peak of the 90s bubble. But, and this is the key, they argue the underlying mechanics are completely different.
How so? I mean, spending is spending.
It's all about utilization. Think back to the 90s. Companies laid thousands of miles of fiber optic cable, right?
Oh, yeah, the dark fiber. They were betting the internet would fill up the pipes, but it just sat there unused for years.
Exactly. It was all supply waiting for demand to catch up. Today, the situation with AI infrastructure, specifically GPUs, is the total opposite.
You mean there's no dark silicon?
Not a bit. The moment a new GPU gets plugged into a server rack, it is running at 100% capacity. The demand is outstripping the supply.
So instead of building a highway and hoping cars show up, we have a massive traffic jam, and we're frantically trying to pour more concrete.
That's a perfect analogy. Oh. And they predict this capital spending on innovation will rise to 12% of GDP.
Wow. And a huge piece of that has to be data centers. I saw the stat. They expect spending to go from $500 billion today to $1.4 trillion a year by 2030.
It's a lot of concrete and electricity. But the why here is about the immediate return on investment. This was a real aha moment for me in the report.
You're talking about the productivity gains from AI tools.
Yes, exactly. Think about using ChatGPT or Claude. You pay, what, $20 a month for a subscription?
Right.
The research suggests that for an average knowledge worker, that tool pays for itself in about half a day's work. The payback period is basically zero.
Which explains why the demand is so intense. It's the cheapest employee you can possibly hire. But this creates a tension that I found really interesting in the report.
The software shakeout.
Yes, you'd think an AI boom would lift all the software boats. But for a lot of the big, established players, it's actually the opposite.
It's a huge threat. For 20 years, the model for companies like Salesforce or Microsoft has been seat-based pricing. You have 100 employees, you buy 100 licenses.
But if AI makes my team 30% more productive, maybe next year I only need 70 employees.
Right.
Or maybe the AI just does the work of the software itself.
And your revenue shrinks.
Mm.
The source predicts massive consolidation. They compare it to retail, where you end up with a couple of giants, like a Walmart of software, and the mid-tier just gets wiped out.
So the winners are the new guys, the OpenAIs and the Anthropics and the platform companies that are building the actual plumbing for all this.
That's the argument. It's about being on the right side of change.
Okay, let's bring this down to the consumer level. The report talks about AI agents changing how we shop.
Yeah, this is where it starts to get a little bit sci-fi. They estimate that by 2030, a quarter of all commerce won't be you clicking a buy button.
So I just tell my phone I'm running low on coffee, and it handles everything.
It might even know you need coffee before you do. But think about what that does to advertising. They estimate 65% of the ad market will be AI generated.
So you have an AI writing an ad to convince my AI agent to buy a product for me.
My bot talking to your bot to haggle over the price of soap?
I feel like I'm becoming obsolete in my own shopping experience.
Well, you're removing the friction.
Yeah.
But it completely upends the business model of the internet, which is all about human eyeballs on ads.
Well, if the robots are doing the shopping, we need to talk about how they're paying. Let's get into the financial revolution section. The report goes heavy on crypto and specifically Bitcoin.
It does. And it tackles the biggest critique head on, which is the comparison to gold.
Right, the whole digital gold narrative. But when you look at the charts, they don't really move together at all.
The correlation is incredibly low, something like 0.14. But the source argues Bitcoin is unique because it plays two roles at once. It's a risk-on asset, trading like a tech stock because it's new tech.
But it's also a risk-off asset, an inflation hedge. And I want to get into why they think it's a better hedge than gold.
It all comes down to the supply response. Let's say the price of gold skyrockets to $3,000 an ounce. What happens?
Every mining company on the planet starts digging bigger holes. They flood the market with more gold to capture that high price.
Exactly. High prices create more supply, which pushes the price back down. That feedback loop is completely absent in Bitcoin. It's mathematically capped at 21 million units.
So if the price goes to $1 million, the code doesn't care. It doesn't release a single extra coin.
The supply curve is a vertical line. It's the only asset that's completely indifferent to demand.
But while Bitcoin is the vault, the actual movement of money, the utility, seems to be happening with stablecoins.
Yes, this was a surprise. Stablecoins are just tokens pegged to the dollar, but they're doing the boring, heavy lifting of global finance. The report notes they've passed $300 billion in market value.
And they're being used for remittances,
Yep.
right? Sending money home.
That's the key use case. If you're sending money to family in the Philippines or Nigeria, you're not using Bitcoin anymore because of the volatility. You're using a stablecoin. It's faster and way cheaper than the old way.
But the number that really blew my mind was about tokenization. Can you explain that concept?
Sure. Imagine taking a real-world asset, like a skyscraper or a U.S. Treasury bond, and turning it into 1 million digital puzzle pieces on the blockchain.
So anyone could buy or trade a tiny piece of an office building from their phone.
Instantly.
Mm-hmm.
And the report thinks this market goes from about 19 billion today to 11 trillion.
11 trillion.
Trillion with a T. They think sovereign debt, equities, bank deposits, all of it eventually moves onto these new rails, which, if you're a big bank, is a massive dislocation.
You either adapt or you become a dinosaur.
Pretty much.
Okay, so we've got digital brains and digital money. Let's move to the physical world. Because this acceleration isn't just on screens, it's literally happening in orbit.
The space section. The numbers here are almost comical. The source basically says SpaceX is a monopoly, sitting 10 years ahead of any competitor.
Is that just hype? 10 years seems like an eternity.
The data seems to back it up. They look at upmass, the literal tonnage of stuff launched into orbit. SpaceX handles about 85% of the global total.
And it's all because they figured out how to land the rockets.
Reusability. It collapsed
Yeah.
the cost. And because the cost is so low, you can do things that sound completely insane, like putting data centers in space.
Okay, wait. Why would I want my server floating in zero G?
It's actually really practical. What are the two biggest costs for a data center on Earth?
Electricity and cooling?
Exactly. Servers get incredibly hot, space is naturally cold, you have 247 access to unfiltered solar power. You solve your two biggest operating expenses just by leaving the planet.
That actually makes a ton of sense. It's the ultimate cold storage.
Okay, let's come back down to Earth, though, because I want to talk about autonomous vehicles.
Ah, yes, the robo-taxis.
The math in the report here, I mean, I had to read it 3 times. The 24 million calculation. Walk us through that.
It's provocative. So there are about 280 million cars in the U.S. today. Now think about your own car. How often do you actually drive it?
Maybe an hour a day, 5% of the time, tops. It
Yeah.
just sits there.
Right. It's a terribly utilized asset. An autonomous robotaxi doesn't need to park. It drops you off and immediately goes to pick someone else up. It can be utilized 50 or 60% of the day.
So one robotaxi does the work of 10 or 12 regular cars.
That's the math. To cover 100% of all the urban miles driven in the U.S. today, you wouldn't need 280 million cars. You would only need 24 million.
That implies the auto industry shrinks by 90% in volume. If I'm Ford or GM, that's terrifying. It shifts the entire value proposition. You're not selling a metal box anymore. You're managing a fleet and selling a service. The report calls it platform power, and they think the platform providers will capture the lion's share of a potential $34 trillion market.
And they're bullish on Tesla winning this race.
Very bullish. They estimate Tesla's cost per mile will be 50% lower than Waymo's because they use cameras instead of expensive LiDAR sensors. They see a winner-take-most market.
It's not just moving people, it's moving stuff. The logistics section mentioned drones.
Yes, and it's another cost collapse. A typical DoorDash delivery with a driver in a car costs about $15.
Which is why my $12 burrito ends up costing $27.
Exactly. With an autonomous drone, that delivery cost drops to less than $1.
From $15 to under $1, that changes the physics of commerce. You could have a single cup of coffee delivered and it would make economic sense.
And it's not theoretical. Companies like Zipline are already doing millions of these deliveries.
All right, let's pivot to health. The report uses the term multiomics. What exactly is that?
It's basically the convergence of AI and biology, using massive computing power to understand our DNA, RNA, and proteins all at once.
And the promise here is moving from just treating disease to actually curing it.
Curative economics. That's the key phrase. They use hemophilia as a case study. Right now, it's a lifetime of expensive injections, a subscription model, really.
Right.
But a new gene editing therapy could be a one-and-done cure. The question is, how do you price a cure?
It has to be expensive if it saves the system millions over a person's lifetime.
The math they use is that the total value of the cure to the healthcare system is about $11 million per patient.
Wow.
So a company could charge, say, $3 million for that single shot.
Which sounds like a lot, but
But the insurance company instantly saves $8 million. The company makes money, the system saves money, and most importantly, the patient is actually cured. It's a win-win-win.
incredible. Okay, finally, let's talk about the engine room for all of this. Work and energy. Because if AI and robots are doing everything, what are we doing? The big fear is mass unemployment.
That's the fear. But the source takes the optimistic, contrarian view. They argue this is the golden age of entrepreneurship.
How so?
Well, think about the barriers to entry. 10 years ago, if you wanted to start a company, you needed a team of engineers, marketing, customer service,
A lot of capital.
a ton. Today, you can have ChatGPT write your code, Midjourney do your design, and AI agents handle customer service. One person can do the work of a 50-person company.
We're already seeing examples of that, right?
Absolutely. There's a stat about Tether, the stablecoin company. They generated roughly $50 million in revenue per employee.
50 million per person. What does a normal bank make?
For context, a giant like Goldman Sachs is somewhere around $300,000 or $400,000 per employee. So Tether is operating at over 100 times the efficiency.
That's what the great acceleration looks like on a spreadsheet. But there's a bottleneck, right? Energy. You can't run all these AI models on good vibes.
You need massive amounts of baseload power. And the report is adamant. We need nuclear. They argue if regulations in the 70s hadn't strangled the nuclear industry, our electricity costs would be 40% lower today.
So to get the AI future, we have to embrace the nuclear past.
It's the only way to power the data centers without, cooking the planet.
So let's zoom out. We've covered a ton of ground. 7% GDP growth, cars disappearing, cures for diseases, one-person billion-dollar companies. It sounds utopian, but also completely overwhelming.
It is. But the main takeaway isn't any single prediction. It's about the flywheel effect. Better AI helps us design better robots. Better robots help us build cheaper energy. Cheaper energy helps us run more powerful AI.
They all feed each other.
Exactly. And once that flywheel starts spinning at this speed, it becomes very, very hard to stop.
So we always like to end with a thought for people to chew on. And for me, I just can't stop thinking about our cities. Yeah.
Empty city concept.
Yeah. If that math about the cars is even half right, if we go from 280 million cars down to, say, 50 million, what happens to the street you live on?
It's a fascinating thought experiment. I mean, just look out your window. Driveways, garages, street parking, massive parking structures downtown. That is all valuable real estate dedicated to storing metal boxes that we're not even using.
So if 90% of those cars just vanish, do we widen the sidewalks, plant millions of trees? Do we build new housing in all those old parking lots to solve the affordability crisis?
Or do we just fill the space with more Amazon drone fulfillment centers?
Probably that, but it totally reimagines the physical landscape of our lives. We might look back at parking lots the same way we look at horse hitching posts today, a relic of a much slower time.
And it might be coming a lot faster than we think.
Thank you for listening to today's episode, and don't forget to like, subscribe, and share your ideas for future episodes. See you next time.